Hi, and welcome back to the WHVP podcast. In this episode of the podcast, the WHVP team sits down to discuss investment strategies and considerations that investors should take when selecting an investment strategy. Before we get into it, the team will discuss the news of the Swiss government ensuring a sustainable energy future. We also will update you on our plans at WHVP to visit the US at the end of 2021. Let's get into it. All right, so welcome back to the WHVP podcast. I'm Jess Roberson, sitting here with managing partners Jamie Vrijhof-Droese and Urs Vrijhof-Droese. And today we're going to be talking about investment strategies. Before we get into that, though, we're going to talk about the Swiss government streamlining their energy transition. Just a quick news thing. Have you guys heard much about it? Read a little bit about it?
Yeah, it's been in the news this morning, I believe. It's a big talk about like what to do with the electricity. But yeah.
Yeah, I think one big issue there is that Switzerland lies in the middle of Europe, and there are some tensions between Switzerland and Europe when it comes to how to make sure that energy is provided efficiently. And since there has been some problems with other negotiations between Switzerland and Europe, we have now this discussion about the electricity and how we can exchange electricity and energy in general. And so yeah, we are in a special situation there, and we really hope that there will be a solution in the long term. But for Switzerland now, it is very important that we find a solution for ourselves, so that we have a plan B if Europe doesn't get along with us and doesn't, or is not interested enough to find a solution with us.
Yeah, and I think on top of that, which is really interesting about the Swiss population, is a couple years ago, the Swiss voted to end their nuclear power plants. So they're currently working on that goal of deconstructing their nuclear power plants and switching to hydroelectric energy sources, so from water or then from wind. And currently the process to actually get those projects built it takes a lot of time due to the bureaucracy in Switzerland. And so what they're trying to do in the government, was interesting this morning reading about that, was how they're trying to almost do the Amazon of government, of where Amazon wants to get you the least amount of clicks to get you to buy something. The Swiss government is trying to work with constructors of hydroelectric plants with water or wind to streamline the process. Often these projects, because they're so big, so monumental, they get stalled for 5, 10, in Switzerland's case, even one of the dams, they've been trying to raise it and grow the plant for 20 plus years. It's been in court. And so they're trying to figure out a way, how do they safely streamline this process, trying to bring clean energy sources that will be sufficient for Switzerland, as it was mentioned, to be self-sufficient at the same time, have a clean energy source. It's a massive project, but that's one thing that's very cool about Switzerland, is what the public says the government has to get done. And I think it's really cool to see that, from the outside. It's not necessarily a finance topic, but from the outside, to see how the Swiss work and how they function and how they've been able to be such a stable country for so long, is the government working with the people and going back and forth. So it's quite interesting.
Yeah, I mean there is some, or there are some relationships to the financial topics, because if Switzerland has too much of electricity power, they usually sell it to Europe and the other way around. And if you have this huge construction size and all this spending which is going on, all of that has to be amortized over the years and will be part of the electricity cost. So we will see where this leads.
Yeah.
Yeah, and I think it's also quite impressive, in my opinion, at least, how Switzerland, as such a small country surrounded by the European Union, is really standing up for its independence, because that was also a vote that was put in front of the Swiss population, and we have voted no several times to join in the European Union. And it's not always extremely easy to negotiate with such a large and powerful partner, but so far I think Switzerland has done a pretty good job in getting us involved in the most important agreements and having good trade negotiations and all things like that, but still at the same time saying, no, we don't want to be part of this union, we want to be our own country and having our own sovereignty. And I think this balance is struck pretty impressively.
Yeah, being independent is good.
Yes.
Yeah, true. Yeah. So cool, let's jump into our topic of today.
Wait, before we jump in,
yeah,
I would like
Whoa.
I would like to quickly talk about our travel plans again. I think we have already touched upon it last time, but it is coming closer, and we still have a few spots left for one-on-one meetings. We'll do a city tour basically over the next 3 months, where we will visit a variety of states and cities in the US. We will start with Miami on November 21st, I believe. Urs will be there for approximately a week and then move on to LA and be there for about a week at the end of November. I will fly to Chicago, will be there in the week of Thanksgiving, and then on Black Friday I will fly to New York and be there for about a week. And then in December, Jess will have a variety of meetings in the Colorado area, is that right?
Yep, Front Range.
Denver, right?
Yeah, Front Range, so Fort Collins, Denver, Colorado Springs area.
Yeah, exactly. And then in January, I will be in Orlando for the week of the 10th. And in February, on February 4th, I will be in Las Vegas and also visit Phoenix for a day. So if any of those cities are where you live or close to where you live and you would like to meet with either Jess, Urs, or myself, then please again reach out to info@whvp.ch. We'll be very happy to meet as many of our listeners and interested people as possible, just to tell you more about all the topics that we have covered over the past couple of months, tell you more about Switzerland, what we do, and also hear more about your financial situation and answer any questions that you might have surrounding offshore banking. So please do not hesitate to reach out, and we're happy to arrange for something.
Yeah,
and now we can head
into
our topic of the day.
So the topic of the day is going to be investment strategies. So something that we as an independent asset manager do is work with clients to determine investment strategies that will best fit their goals and some other considerations. So I'll quickly just kind of give the definition of investment strategies and kind of a quick synopsis of what they can be. There is a myriad of investment strategies that can be taken to help guide investors' decisions making throughout the lifetime of their portfolio. Whether that's you're just a totally new investor, where do you start? What strategy do you take? Or let's say you're 25 years in and you've had a strategy, or can that be changed? So the first thing is to focus on is there's so many strategies. It's good to always revisit that and see if it still fits the parameters that you have as an investor. Whether that strategy, let's say, is a growth strategy where you're trying to really grow your investments or your capital that you're investing as fast as possible, that would be considered a aggressive or a growth strategy. Then you'd have a moderate, where you're trying to grow your strategy but lower the risk that you're taking. So in every investment, there's a risk reward that you have to consider. And obviously, the greater the risk, there's the greater the potential for a reward. So a moderate strategy looks at, okay, I want to grow my capital that I'm investing, but I don't want to take as much risk in the investments I'm placing in. And finally, you have capital preservation, which is a low risk strategy that can be taken to preserve your capital. So you've built up wealth, you want to preserve the wealth that you've built up, You want to grow it, but you want to take as little risk as possible in growing that wealth. So that would be considered capital preservation strategy. Now, there are various types of strategies that fit into those three categories. As far as what kind of investments you're putting your money into, and how you weight your portfolio. And weighting your portfolio is where are your investments and what different investments. Are they in equities? Are they in bonds? Are they in funds? Are they in precious metals? Are they in alternative investments? And how you structure your portfolio will be guided by what strategy you have, and how much you'll take depending on those things. So to consider, to figure out for the investor where you might be on that level of which strategy category you would be most interested in growing or building your portfolio, there's a few things to consider. First is your age. How old are you? Are you young? Do you have 40 years to retirement, or do you have 5 years to retirement? So age is a big consideration. The next is, what are your goals? Are you planning to retire at 30 and you're 21 right now? Are you planning to retire at 75? Or in Switzerland, you kind of have the cutoff date at 65, where they say this is when everyone kid goes into retirement. And how far away are you from that? What do you want when you get that point? Do you want 2 million? Do you want 10 million? Do you want 500,000 because you have other investments that are going to take care of you, or retirement accounts that are going to take care of you? What's your lifestyle? What are your costs? It's another consideration to have when you go into investing, because you have to know how much you can invest each year, and how much you can invest right away. Are you planning to buy a house in 5 years? Maybe it's better to hold off on starting that portfolio. Or you've already bought your house, so I can spend $15,000 a year to regularly invest. And then what's your financial situation? Debt is a big thing that a lot of people carry, especially in the US. Are you still carrying those student loans? Are you carrying a mortgage? Do you actually have money to invest? Are you just paying off your mortgage to the interest rates? So getting rid of debt, what's your financial situation? How much, that kind of goes into lifestyle, but where does it fit? And then, do you have available capital? As we mentioned, are you going to buy a house? Have you been saving up for that house? Do you just have money sitting in the bank account earning 0.0005 interest that can be used to actually grow your wealth a little bit? And what's your living situation? Do you have a parent that maybe is going to be going into an old folks home, or moving in with yourself, where you're going to need to take care of that parent, or a kid who maybe is going to be going to college? So you have to kind of look at your personal situation to see, can you actually afford to spend that $15,000 on a portfolio? And then finally, what do you expect for returns? What's your desire? Look at, I want to earn 5% on my portfolio a year. I want to earn 10%. It's kind of setting that. These are the things you can consider before going in. And finally is, should you work with a professional? And how do professionals actually help? And so, Urs, I think you'll kind of walk into the strategies and portfolios, or investment strategies, and some more considerations about that.
Yes, I think you brought up very good points when it comes to what you have to consider, what thoughts you have to do before or when getting the process started. I think it's another also very important point is, what is your capacity to risk? So how much can you not necessarily lose, but if whenever you do an investment, it can also go down. And we have seen it very impressively last year when the effects of the coronavirus and the lockdowns hit in, when the markets took a dive of 30 to 40%. And now we are here 18 months later, seeing the markets being up 10% compared to where we have been before the corona crisis. So are you able to hold on even if things are a little bit rocky? And but I think when it comes to the investment strategies, there are some different strategies. So the most famous one are value investing, or growth investing, momentum investing. I think the point with the financial situation is also quite essential when it comes to choosing the right strategy, because if you say, okay, I have $100,000 and I want to invest 100,000 and I can't really split it up, then you should go with a strategy which you can hold on in the long term, which mostly is a value or a long-term value strategy. But if you have a portfolio of 2-3 million, you might be able to split it up and say, okay, 20% of it I will put into a growth strategy, which is more risky. I don't have a look too much at it, and I let it be handled by a professional. Another part of maybe 50% I take into value investments, where I can just buy the stocks I like, which pay good dividends, which have a stable balance sheet, like boring investments we know, like Coca-Cola or Apple or whatever. And then you have still 30% left, where you can take, for example, a momentum strategy, or where you can do something which is maybe something that is fun for you. You can, for example, buy a rental house and then rent it out, or whatever. So I think that there are very a lot of strategies you can choose from, and it is important that you choose a strategy where you know, okay, I can hold on like for a long term, because often it needs about 5-10 years so that it really works out. And if you lose your what is it called?
Initial investment.
Patience.
Yeah, if you lose your patience, then yeah, hopefully you will not lose your initial investment. But if you lose your patience after 2 years and change the strategy, that's kind of the worst you can do. Because if you lose patience and you change it, mostly it will be right at the bottom, and that's very important to keep in mind. So stay the course, even if it is if it is difficult, as long as your situation hasn't changed.
I think that, if I may jump in, it's also one of the reasons why working with a professional can add a tremendous benefit, because it takes the emotion out.
Yes.
So you have like this barrier between you and your portfolio, because the professional investor, you're most likely not his or her only client. So he or she can really look at the portfolio from an objective point of view. And I think there are points in time where you do have to say goodbye to a bad investment, or where you do have to liquidate part of your portfolio, but it shouldn't be a spur of the moment thing where you just panic or again lose your patience. And if you work with someone who does that for a living, you don't have to rely on your own emotions anymore, and you can have some more peace of mind knowing that someone with a more rational approach maybe is looking after your money. And I think that can be very helpful to people who feel that they are quite emotionally invested into the performance of the portfolio.
Yeah, and a good solution to this point, taking out the emotion, is if you're able to make like regular payments. If you say, okay, I pay every quarter or every month a certain amount into the portfolio, which will be managed either by someone else, by a professional, or by yourself, you are able to take out the emotions, because you're stopping to try to time the market. Because you say, okay, I invest every month $1,000, and if I have a good or high courses, I buy at high courses, but if it drops, I buy at low courses, and at the end you have a good average. And if you believe that the markets in the long term always go up, then it shouldn't be a problem. There of course you have to watch out what kind of investments you take in. Do you take in some funds, some ETFs, or do you do some direct investments? I mean, with direct investments, it is still important, even if it's a boring investment. I call it now boring, but if it's like a stable long-term investments, you still have to check in from time to time and look how they do.
Of course.
Yeah, I fully agree. Maybe we can talk briefly about some of the specificities of having investments offshore, because there are some specific considerations that you have to think about when your investment strategy includes assets abroad. I think, well, first and foremost, and the most well-known probably in the investment community are what we call PFICs, passive foreign investment companies. Broadly speaking, that is relating to any kind of funds and ETFs that are denominated outside of the US, that are not specifically registered in the US, and those investments for Americans can have significantly negative tax consequences, and they can also make the filing of your taxes much more complicated. So what we do at WHVP is we completely exclude PFICs from our portfolio, so we make sure that none of our investments qualify as that. If you have investments abroad that you manage by yourself or that is managed by another company, you should really make sure that you don't have any PFICs in your portfolio. And if you do have them in there, that you are aware of them and that you are aware of the tax consequences and also the reporting requirements that comes with that. And then what we also have here in Switzerland is a withholding tax. So on dividends and interest, I believe, you have a withholding tax of 35% that will automatically be deducted. Most banks that we work together with automatically reclaim the tax on your behalf, but it can take a year or two until you get the money back. And also a small administrative handling fee will be deducted from the side of the bank for reclaiming the money on your behalf. So the amounts that you will lose or the work that you have to invest is, I would say, negligible, but it's still something that you have to know. And then the last point in regards to taxes, or maybe second last point, would be the stamp duty that is also affecting stock investments here in Switzerland, where you have to pay a small fee or respectively a small tax when you purchase a stock or a bond investment. And then lastly, I think it's also important as an American, if you work together with an investment advisor abroad, that even though those people are usually not tax attorneys or tax specialists, that we ourselves do also not consider ourselves tax specialists, but it's so important that they are aware of the tax consequences of, for example, long and short-term capital gains, so that they are aware of the fact that you can offset gains with losses, that there are different levels of taxes depending on how long you've held an investment. And I think it's just important that you yourself are aware of those things and potential pitfalls, and that if you screen a professional investor, that you are looking out for those things, and that you make sure that you have a partner that is aware of those things as well, so that you don't fall into any problems, or that so that you don't make your life more complicated than it needs to be, and so that you don't pay more taxes that you have to pay.
Yeah. These are good points, and one important or one good possibility how you can have an investment with not taking into consideration these long and short term gains issues is if you have an IRA. So if you have an IRA, you don't pay any taxes. So everything which you have in your IRA should be excluded from tax implications in this regard. Yeah,
that's a very good point. I think it's also it makes sense to have different investment strategies for different types of accounts.
Yes.
So yeah, with retirement money, of course, you might want to invest that differently than, I don't know, a trading account or a savings account that you have. So yeah, to think about where the money comes from and what kind of money it is and what kind of purpose it has, and also what kind of tax implications it has, I think that's a great point to make, and that's important for people to keep in mind as well.
Yeah, I think those are all very, very good points. And Jamie, maybe you can talk a little bit more about what we do professionally at WHVP with in regards to investment strategies.
Yeah, absolutely, of course. I mean, this is our bread and butter work, is putting together investment strategies that fit the specific clients that we have. We pride ourselves in having a rather small client base, so that every relationship manager that we have, so here that would be Julia, Urs, and myself, that we really have a small amount of clients, so that we can know each and every person and their families personally, that we know their values, in life, but in finances more specifically. And this process starts at the very beginning, before the account has even been opened. We talk about the investment philosophy of our clients, and there we can already see if we are a good fit or not. Because if a person would like to have their portfolio 50% in hedge fund and 50% in cryptocurrencies, then it's probably not a good fit with our philosophy. And while almost all of our accounts are tailor-made, we still have an overall investment philosophy that is more on the conservative side of things. And while we do have different levels of risk and rewards in that sense, we still don't do any of the very high risk or alternative or illiquid investments. So I think there, in the first step, it's very important to see if we are generally aligned or not. Then with the client that we do onboard, where we feel that generally we are on the same page, we then have an in-depth discussion where we talk more about things that fall under the KYC segmentation, so the know your customer rules here. So where we learn more about how the money was acquired, in what kind of career stage the client is, what the time horizon is, basically all of those things that you just have mentioned in the beginning, so that we really have a good understanding of the client, that we also see what is the time horizon for the client, and what is the idea if, for example, something happens to the client, if it's an older person, maybe we also include the potential people who will inherit the money, and then we'll make a suggestion. We'll put together an investment strategy where we determine together with the client the level of risk that they're willing to take, and then we basically determine bandwidth for the 4 asset allocations that we have. So in our case, there will be foreign currencies, stocks, bonds, and precious metals. And then within those bandwidth, we then include the personal wishes and preferences of the client. So we have some clients with quite extensive lists of restrictions, with companies and industries that they don't feel comfortable investing in. And then we have some clients who have very specific markets that they want to get in. We include all of that and then put together an initial investment strategy. And then depending again on the client's wishes and preferences, we talk about this strategy at least once a year, but sometimes up to 4 times a year, where we just quickly check in, see if we're still on the same page, if there's a need for a change, either because of the financial situation of the client. Sometimes someone needs to take money back to the US, sometimes some people want to make investments into a house or a car or whatever. And also where we take into consideration the market developments and just see if we can stay the course or if there's some need for adjustment. And then we're basically taking it from there with ongoing communication, with some back and forth by email and phone. And nowadays also Zoom meetings, where we just check in and talk about where we see things going, and where we talk with the client about where they see things going, what they would like, and then we make gradual adaptations if it is needed. But most of the time, I would say our strategies are set up in a very long term. Oftentimes the clients don't really change their preferences or their underlying factors oftentimes stay the same for several years. So we most often have portfolios that are quite consistent in the long term, where we can really benefit from this value investing that we have for most of the portfolios that we manage.
Yeah. Yeah, I think it's. I thank you, Jamie, for talking about that. I think it's really important that people understand the differences between when we talk about value investments. That when we look at value investments from, as Jamie mentioned, a conservative standpoint, we're looking at capital preservation in all of our investments. Yeah, obviously, if we choose higher, if we have maybe potentially a client who wants a higher level of risk, we're still, as WHVP, we're capital preservation specialists. So even the investments we're selecting, we're trying to look at getting the best value with the lowest amount of risk. Mm-hmm. And I think that's important to point out, because we're here, again, as Urs mentioned, and Jamie, we're here for the long run. We want that wealth to grow over a long period of time. And our strategies are set up that way, and I think it should really be highlighted that we're not trying to time the market. We're not trying to hit the exactly the right moments of when we're going to make the most money in the next 2 months because we found a great opportunity to go in. We're trying to grow the bulk of the wealth for a long time. In my opinion, that's where wealth is created. That's where true wealth is created, that you're going to be able to hand on to your next generation and the generation after. It's not a get rich quick scheme. It's a let's grow the wealth together.
Yeah, absolutely, couldn't agree more.
Yeah, and it's really very, very important that to manage the expectations and to see, okay, what do the clients want, and are we able to provide this kind of service they want? Because if not, it doesn't make sense to go through the whole process of opening an offshore account, and after 6 months you have to close everything and take it back again. So it's really important to take enough time to evaluate whether this is a good fit, but also, of course, at the end to being able to make a decision and say, okay, now I go for it, and I go for it for the next 5 to 10 years, so that you know what you're going into.
Yeah, I think it's very valuable to build the relationship with your investment professional that you're going to be working with. Without the relationship, everything is more complicated. And so taking that time initially to build that trust, to build that connection, and find out, do I as the investor really want to work with this asset manager? And as Jamie and Horst both mentioned constantly, does my expectation fit with the expectation of the professional I'm working with? And throughout this conversation today, we've talked about taking emotions out of investing. There's going to be, in my opinion, there's always going to be emotions in investing. You're putting your livelihood, what you've built into it. So how can you find that investment professional who you can talk with, who you can share those emotions with, who can act as a good sounding board and be able to go through you with those things and reduce the severity of those emotions. If we ever turn on the TV in the States, it's very theatrical and explaining movements and stuff. So how do you go in and navigate through that noise to really stick with something? And I think that's something I've watched Jamie and Urs do very well. And it's what I like about WHVP is how we approach investing through a very long-term approach that's actually valuable for clients.
Yeah, maybe one last point from my side. We talked about consistency quite a bit now, and also look out for consistency in your financial partner, in your financial advisor, because for us it is very important as the owner of the company that we will be here for at least the next 30 years, and that we will be able to go through different situations in life and be there as an advisor, as a friend a little bit also, so that the client knows, okay, if I come back or if I have a question in 10 years, if there is something happening in my family or in my personal situation, I know this person I'm talking to, they know already what my history is.
Thanks again for joining us on this episode of the WHVP podcast. If you're interested in getting into contact with us at WHVP for any reason, you can email us at our contact email at info@whvp.ch. If you want to check us out on any of our social media handles, you can find us on Instagram, LinkedIn, Facebook, and YouTube by simply searching WHVP. Have a great week.